The global financial crisis refers to the event that occurred in 2007-2008 and had a significant impact on the global economy. This crisis was primarily caused by the lending and payment problems in the real estate sector in the United States. The fundamental cause of the crisis was the continuous increase in house prices in the U.S., coupled with banks providing risky mortgage loans. A portion of these loans could not be collected due to homeowners' inability to repay. As a result, banks were unable to repay their debts and went bankrupt. This crisis affected the entire world economy because the bankruptcy of U.S. banks also impacted financial institutions in other countries. The crisis slowed down economic growth worldwide, increased unemployment rates, and increased the debt burden of many countries. To mitigate the effects of the crisis, many countries' central banks and governments reduced interest rates to lower borrowing costs and provide liquidity to financial markets. Some countries implemented economic stimulus measures by implementing tax cuts and increasing government spending to prevent the crisis. The global financial crisis is a significant event that had serious implications for financial markets and the world economy. Therefore, measures have been taken, such as financial regulations and risk management, to prevent a similar crisis from occurring again. What led to the collapse of Lehman Brothers and what was the impact of this event on the global financial crisis? What were the risk management mistakes behind the bankruptcy of Lehman Brothers? What kind of panic occurred in financial markets during the collapse of Lehman Brothers? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
Lehman Brothers is an investment bank based in the United States. It began as a textile merchant firm founded by three brothers, Henry, Emmanuel, and Mayer Lehman, who migrated from Germany to the United States in 1850. Later, they expanded their business and ventured into investment banking. Lehman Brothers continued its growth by opening offices in major U.S. cities in the early 20th century. Investment banking activities gained momentum, particularly in the 1920s and 1930s, with the expansion of financial markets, and Lehman Brothers became a significant player in this field. In the 1970s and 1980s, Lehman Brothers started operating as a major asset management company in the capital markets. During this period, Lehman Brothers became an investment bank offering numerous investment opportunities for investors worldwide. In the early 2000s, Lehman Brothers experienced significant growth through its investments in the real estate market. However, in the global financial crisis that erupted in 2007-2008, Lehman Brothers' high-risk investments led to its bankruptcy. This bankruptcy was seen as the peak of the global financial crisis. Lehman Brothers came into the spotlight with its bankruptcy, which was one of the most significant events of the global financial crisis in 2007-2008. The collapse of Lehman Brothers deeply affected the global financial system and caused severe economic distress. So what are the factors that led to the collapse of Lehman Brothers? High-risk investments. Lehman Brothers went bankrupt due to its high-risk investments in the real estate market. The company tried to profit by packaging mortgage debts in a risky manner and selling these packages to investors. However, most of these investments were structured as bonds and later became worthless. Leverage ratio. Lehman Brothers operated with a high leverage ratio. In 2007, the company carried a debt burden of $691 billion. This high debt burden increased the risk as it exceeded the company's capital. Liquidity issue. Lehman Brothers faced a liquidity problem after its bankruptcy. The company did not have sufficient cash flow to sell its high-risk assets, resulting in its bankruptcy. The collapse of Lehman Brothers deeply affected global financial markets and created waves in the world economy. The ripples of the crisis initially concentrated on financial markets but later spread to economic growth, employment, and income distribution. So what are the effects of the global financial crisis on the world economy? Economic growth. The global financial crisis caused a severe contraction and slowdown in the world economy. The impact of the crisis was particularly felt in the US and European economies. The crisis negatively affected economic growth due to reduced consumer spending, increased unemployment, decreased investments, and contraction in production activities. Employment. The global financial crisis led to an increase in unemployment rates worldwide. Businesses had to lay off workers due to financial difficulties. Additionally, the reluctance of businesses to invest also contributed to increased unemployment. Costs. The crisis resulted in increased consumer and producer costs. These increases triggered inflation. Moreover, the measures and support packages implemented by financial institutions and governments also adversely affected public finances. The global financial crisis prompted many governments worldwide to reconsider their economic policies and take various steps to cope with the effects of the crisis. The reactions of governments to crisis management varied depending on the severity of the crisis and the economic situation of countries. Economic stability programs. Many governments implemented economic stability programs to combat the effects of the crisis. These programs were designed to rescue financial institutions, reduce unemployment, boost consumer confidence, and stimulate economic growth. Interest rates. Some governments sought to stimulate the economy by reducing interest rates during the crisis. Low interest rates help reduce borrowing costs for consumers and businesses, encouraging increased spending. Fiscal policies. Some governments attempted to revive the economy through fiscal policies during the crisis. These policies included increasing public spending, tax cuts, and financial support packages. The global financial crisis led to significant changes in financial regulations and reforms. The causes and effects of the crisis created awareness of the need for tighter regulation of the financial system. Here are some examples of post-crisis financial regulations and reforms. Dodd-Frank Act. The Dodd-Frank Act, adopted in the United States, aims to regulate and supervise financial institutions more tightly. Some provisions of the Act include higher capital requirements for financial institutions to control risky behavior, better regulation of financial products, and new regulations for consumer protection. Basel III. Basel III is a set of regulations prepared by the Basel Committee to make the global financial system healthier. It includes higher capital requirements for banks, stricter rules for risk management, and tighter regulations to reduce systemic risks. G20 reforms. Following the 2008 crisis, G20 countries decided to collaborate on financial regulations and reforms. G20 reforms include tighter regulation of financial institutions, stricter rules on risk management, and increased transparency in financial markets. The global financial crisis was a significant shock for investors. Many investors adopted a more cautious and prudent approach after the crisis. Here are some examples of post-crisis investment strategies. Diversified portfolios. Investors started diversifying their portfolios more to seek less risk and more profitable investment opportunities after suffering significant losses due to the crisis. Investing in more sectors, more assets, and more regions helps diversify risks and achieve a better risk-return ratio across the portfolio. Shift to lower-risk assets. Post-crisis, investors tended to shift towards lower-risk assets. Instead of stocks and risky bonds, they turned to safer investment instruments such as government bonds, certificates of deposit, and money market funds. These types of assets are seen as safer investment options, even though they provide lower returns. Rebalancing. Post-crisis, investors tended to regularly rebalance their portfolios. This is done to realign the portfolio when it becomes excessively large or overweighted in a particular asset class. Rebalancing helps reduce risks and optimize investment returns. Risk management and measures play a crucial role in preventing financial crises. Regulations. Financial regulations are designed to regulate the behavior of individuals and institutions operating in financial markets to maintain financial stability. Regulations ensure that financial institutions comply with certain standards in risk management and capital adequacy. Transparency. Transparency in financial markets provides information about the prices and trading volumes of financial instruments. It enables investors to access accurate and reliable information, helping them better manage risks and prevent financial crises. Risk management. Financial institutions use various risk management techniques to manage their financial risks. These include investing in risk management tools, risk transfer, risk diversification, insurance, and other risk management strategies. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal economic history.